All right, welcome back. You're watching Trading Calls live on ET Now. Let me bring on board a very special guest indeed, someone who needs no introduction whatsoever, Nouriel Roubini of Roubini Global Economics, someone who accurately predicted the 2008 financial crisis in 2007 itself. So let's hear out how would he like to map the current scenario. Mr. Roubini, really appreciate your time. Thank you for joining us. Mr. Roubini, money managers are divided over the sharp fall in crude and gold prices. If this is good for countries like India and China, do you think the current decline in commodity prices is some kind of an harbinger or signal that in the coming days we could be staring at poor global growth?
In my view, the fall in commodity prices is a signal that investors in financial markets are getting worried about the global economic growth. It certainly is a growth scare, but this growth scare could be more significant. The latest economic data suggests continued recession in the periphery of the Eurozone, now economic weakness even in the core of the Eurozone, recession in France, a slowdown in Germany. The effects of the fiscal drag in the US between tax increases and spending sequesters are now slowing down sharply US economic growth. Japan has been in a recession and deflation, and we don't know whether Abenomics is going to succeed. The United Kingdom is on the verge of a triple-dip recession. And until recently, at least, emerging markets were growing stronger. But now the latest economic data from China, the first quarter GDP growth, the forward-looking manufacturing PMI suggests that Chinese growth slowed down. A similar slowdown has occurred in all the other BRICS. Economic growth in India, in Russia, in Brazil, in South Africa has been disappointing. So while lower commodity prices could look like beneficial for countries that are importing oil, energy, food, and raw material, countries like India, if the reason why commodity prices are falling so sharply is that there is something more than a growth scare, there is something of a global growth slowdown, then the first order effect of that global slowdown on growth, say on India, are more important than the beneficial effects that are secondary of a slower level and lower level of commodity prices. So on net, if this commodity price fall is the result of a weakness in global economic growth, it's on net and negative for commodity importing countries like India, because the reason why commodities are falling is because global growth is faltering.
Professor Roubini, with large crude oil consumers like China slowing down and the US turning net exporter, do you see the era of high energy prices over?
Certainly the shale gas and oil revolution could become over time a game changer. The US is exploiting it, but there are vast reserves of shale oil and gas in Latin America, in Russia, in parts of Europe, in China, and other parts of Asia. US is going to be able to exploit those reserves much faster than other countries because of less concerns about the environment and because of availability of managerial and technical experience to exploit this revolution. All in all, this suggests that the supply of gas and oil could be increasing over time relative to the increase in demand, but the increase in demand is going to remain robust in a global economy where emerging markets are growing fast and you have urbanization, industrialization, population growth, and per capita income growth. But the wild card in energy remains geopolitical risks. If there was a conflict military between, say, Israel and Iran on the issue of nuclear proliferation, the fear premium will go higher. That could spike oil prices, even if the fundamentals of demand and supply suggest that oil prices over time should be lower rather than higher. And historically, geopolitical shocks in the Middle East have been sources of a sharp rise in the fear premium and the price of oil. So that's a risk that has to be considered when thinking about what's going to happen to oil prices in the next few years.
Right. Mr. Roubini, India also stands to benefit on the current account deficit due to fall in crude and gold prices. By when do you think Indian GDP growth will bounce back to 6% plus?
Well, there is a recovery of growth in India driven by easier monetary policy that has occurred in the last few months, and the fall in commodity prices is going to reduce gradually inflation in a way that's going to boost purchasing power and allow further monetary easing by the Reserve Bank. Those are the positives, but then the negatives are that the global economy is slowing down, China is slowing down, advanced economies are slowing down, and while India is not as dependent on trade as China is, of course, the global economic climate affects also confidence and also through trade channel growth in India itself. So India already starts from a situation where growth has been disappointing last year. Global growth was supposed to accelerate. If instead of accelerating, it slows down further in China and US and Europe, that on net is going to be a negative on Indian growth and challenge the ability of India to achieve even a 6% growth this year.
How do you see India policy and reform environment as well as the steps taken so far to kickstart growth? And also, what do you expect on the front given that elections in India are slated next year?
Well, structural reform and liberalization have occurred in India in the last few years at a pace that has been slower than optimal and desirable, and that's one of the reasons why economic growth in India for the last couple of years has been disappointing. The government is trying right now to jumpstart some reforms and some liberalization. That will be a positive. On the other side, the fact that there will be general elections about a year or so from now implies political and policy uncertainty. It might also imply that then in a coalition government it's going to be harder to accelerate policy reforms that have resistance among some social and political groups. So I would say that the pace of liberalization until the election is going to be only modest at best, and that implies that potential growth is not going to be accelerating significantly, and that political and policy uncertainty, regulatory uncertainty, taxation uncertainty is not ideal for the business climate and is going to keep private investment in real capital spending slower growing than would otherwise be.
Right, Professor Roubini, really appreciate the time and thank you for insights. That was Professor Nouriel Roubini, the man who predicted the 2008 financial crisis rather accurately, and he's of the view that the risk to EU, which is the Eurozone, or the EU and Eurozone, they are looking slightly less now. You know, exactly a year ago, last year, everyone was talking about failure in Greece, breakdown in the European Union, but thankfully all those fears are no longer occupying center stage. And Europe, surely for global money managers, has taken some degree of backseat. But for our markets today, we